Meet Emma and Olivia. They are twins, they are 65 years old, and today they're comparing their final retirement accounts to see who came out on top. Olivia put in serious work. Every single month for 35 straight years, she aggressively invested $200. Emma took a different path. She invested half that amount, just $100 a month, and she only did it for 10 years before she stopped contributing entirely. When you look at this chart of their total out-of-pocket contributions, Olivia clearly poured way more of her own cash into the market. But when they looked at their final balances, Emma had noticeably more money. That result feels wrong. We are taught that harder work and larger deposits should equal greater wealth, not the other way around. But Emma took advantage of a mathematical principle so highly leveraged that Albert Einstein supposedly called it the eighth wonder of the world: compound interest. To see how it works, we have to rewind 45 years. At age 20, Emma immediately starts putting away her $100 a month. Meanwhile, Olivia decides she has plenty of time, so she delays investing entirely. Fast forward to age 30. Emma decides she's done. She stops making monthly contributions and never adds another cent of her own money. Here is what is happening under the hood. This animation represents Emma's initial invested money. In its first year, that principal amount earns a percentage return, represented by this smaller, newly spawned block. In the following years, that newly generated return starts earning its own return, completely separate from the original principal. You begin earning interest on your interest. By age 30, Emma successfully shifted the burden of building wealth away from her own active labor and onto the passive engine of time. Which brings us back to Olivia at age 30. Finally ready to get serious and starting her aggressive strategy of $200 a month. Olivia is now using her daily active labor to add new money to her account. Emma's account is totally dormant, relying purely on its existing mass to keep growing. Look at this chart tracking their wealth between ages 30 and 40. Emma's trend line starts to curve upward exponentially without a single new deposit, while Olivia's larger, manual deposits only push her line up at a steady, linear angle. As we extend the timeline out to age 65, that 10-year head start creates an ever-widening gap. The exponential curve completely separates from the linear one, making Olivia's larger deposits mathematically incapable of catching up. When you break down the formula for building wealth, the time variable provides significantly more leverage than the capital variable. This is exactly why Emma crossed the finish line at age 65 with a larger portfolio. Olivia learned a harsh reality. If you try to out-earn lost time, you have to compensate with massive amounts of capital and relentless active labor. Being late to invest carries an invisible, expensive tax on your future wealth. But the compounding engine does not care how much money you make right now, and it doesn't require a massive initial deposit to start working. Building wealth is highly accessible precisely because it relies on early action and a long runway, rather than a high income. Start investing today, even if it is just with a few dollars, and let the mathematical engine of time do the heavy lifting for the rest of your life.